Welcome. In this video, is Xcn coin in a critical place? We will analyze this. Don't forget to subscribe, like, and please watch to the end to understand. One of the most notable technical formations on the chart is a clear consolidation zone, or horizontal channel structure, formed by the price moving sideways within a defined range for a certain period of time. These types of horizontal channels typically emerge during periods of market indecision, when there is an ongoing power struggle between buyers and sellers, and the price is unable to establish a clear direction. This structure contains highly valuable technical levels for both short-term traders and medium-term investors. In the chart we are analyzing, the price has been fluctuating within a horizontal channel where the upper boundary is regarded as resistance and the lower boundary as support. Such sideways movements are often seen as periods when the market is taking a breather and gathering strength before a major directional move. These formations are frequently observed ahead of large breakouts. In the current scenario, the price has reached the lower boundary of the channel, which acts as a support zone. In technical analysis, support levels are areas where price previously halted its downward movement and responded with an upward reaction. Therefore, the price touching this level now increases the likelihood of buyers stepping in again, consistent with past behavior. A possible reaction from this support zone could lead the price back toward the mid or upper band of the channel. Additionally, the lower boundaries of such horizontal consolidation zones are often used as reference points for stop-loss levels. Investors tend to minimize risk in these areas and shape their positions in anticipation of a potential upward move. However, another important point to consider is the scenario in which the support level is broken. If the price falls below this strong support area, it would be interpreted as a sign of technical weakness and could lead to a significant loss of investor confidence. In such a case, selling pressure may increase rapidly, and the price could experience a sharp decline outside the channel. For this reason, this zone represents a critical threshold where both opportunities and risks coexist. Still, we can observe that the price has repeatedly reacted upward from this region in the past. Based on this historical behavior, investors may be inclined to evaluate a potential bounce at this level. If the price initiates an upward reversal with volume support after touching the lower band, this movement could be interpreted as a healthy rise within the channel, and it may be expected to continue toward the upper boundary. In short, the fact that the price has now touched the lower boundary of the horizontal channel is a highly important development in terms of technical analysis. The fact that this level has previously acted as a strong support increases the likelihood of another reaction from this area. For investors, this level may serve as a critical decision point for opening new positions or reassessing existing ones, but looking at trends alone is not enough. Other metrics must also be considered. Keep watching. In chart analysis, one of the most effective tools used to identify trend reversals and retracement levels is the Fibonacci retracement levels, which are considered a cornerstone of technical analysis. This analytical method is used to estimate where potential retracement moves might pause or where a new trend might begin after a price drops from a certain peak level. In this context, when a Fibonacci retracement is drawn from the high point to the low point of a price move, specific percentage levels emerge. These levels, 0,236, 0,382, 0,5, 0,618, and 0,786, represent potential resistance or support areas during a retracement. These ratios represent more than just mathematical values. They also correspond to critical zones that align with investor psychology. In particular, the 0,618 and 0,786 levels are zones where the price may be strongly rejected, or conversely, may break through with strength and gain upward momentum. The 0,618 level, also known as the golden ratio, is one of the most closely watched retracement levels by both technical analysts and algorithmic systems. This is because it has often worked in the past, marking areas where the price reversed direction or where a new trend began. Looking at current price action, we can see that the price is showing signs of recovery after a decline. If this upward movement continues, the price has the potential to rise first to the 0.382 level. The price may face some resistance here, as it's often a zone where short-term investors take profits. However, if this level is surpassed, attention will shift toward the 0,618 and 0,786 levels. A breakout above the 0,618 level signifies the breaking of a major psychological barrier among investors, which often leads to increased momentum and higher price levels. Similarly, the 0,786 level is generally considered the final stop in a retracement, and it is expected that the price will choose a direction after reaching this zone. If this level is also surpassed with strong volume, it would send powerful signals that the downtrend has completely ended. Another key factor to watch here is volume. The rise or fall in trading volume as the price approaches Fibonacci levels is highly important in determining the sustainability of the move. Upward movements with low volume tend to be temporary, whereas volume-backed breakouts are typically indicators of trend changes. In conclusion, Fibonacci retracement levels are a highly effective tool for investors to estimate how far a price might rise or fall. However, these levels alone are not sufficient for making decisions. They must be evaluated alongside other technical indicators, chart patterns, and market structure. In the current scenario, there is potential for the price to move toward the 0,618 and 0,786 levels. If these areas are broken with volume support, significant upward momentum may develop in the market. On the other hand, a rejection from these levels could pull the price back down again. Therefore, these zones should be closely monitored and considered within a sound risk management strategy. The Vortex indicator is an important tool that allows us to analyze the directional trend strength in price movements. This indicator operates with two separate lines. The blue line represents upward movement or buying strength, while the red line represents downward movement or selling pressure. The relative positioning of these two lines provides valuable insight into the current directional bias of the market. Looking at the chart right now, we observe that the red line, which indicates dominant downward movement, is positioned above the blue line, which is associated with buying momentum. This suggests that sellers are still strong in the market, indicating that the price remains in a short-term downtrend. However, one well-known truth in technical analysis is that such formations are often temporary and can signal the beginning of a strong directional reversal. One of the key developments to monitor for a potential upward move is a possible crossover between these two lines. If the blue line gains momentum in the coming days or hours and crosses above the red line, this would suggest that buyers are starting to take control and that an upward trend may be emerging. This type of crossover is often considered one of the first technical signals of a trend reversal. What's critical here is not just the crossover itself, but also how strong and decisive it is. If the blue line crosses above the red line only briefly and weakly, it could be a false signal. However, if the crossover happens with strong volume and sustained upward movement, the likelihood of a more solid uptrend increases. Such a crossover is highly valuable in technical analysis and can be confidently used by investors as a signal when taking positions. In summary, as of now, we see that downward pressure is dominant because the red line, representing selling momentum, is above the blue line, which represents buying momentum. But this current state is not fixed. On the contrary, a directional shift is often expected after every strong decline, and if the blue line rises and crosses above the red line in the coming period, it will be one of the first strong signs that a positive trend has begun. Therefore, the distance and directional movement between these two lines carry significant strategic importance in reading the market. We need to continue monitoring the Vortex indicator. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.